They say it takes money to make money. I say all money is not good money. If someone offered you $1 million to invest in your company right now, would you take it or would you bootstrap? Well, before you answer that question, let me tell you about the dark side of investment money and how bootstrapping might be your best benefit. Let's go ahead and get started. Hey, welcome to a random podcast where we challenge the status quo and we empower people like you to think differently. Now, I'm not trashing VCs or angels. I'm saying there is a dark side to outside investment, and you need to be aware of it to see if it's something that you need to do with your company, or do you need to bootstrap? So today I'm going to give you some examples from my personal life and my personal journey of VC involvement. Now, we all watch Shark Tank and we see how romanticized it looks to pitch your ideal to these investors. And we hear them say, hey, I'll give you this much for this percentage. And it seems all cool and romantic and seems like they're there to help them out and the whole works. But you got to remember, this is business. Has nothing to do with being romanticized. That's all entertainment. Because when the cameras go off, real business starts. Because they want to know what percentage of your company are you willing to give up for the amount of money they're going to give you. So if someone can give you $1 million, how much are you willing to give up? Think about it. You should already have a number in mind. What percentage would you give up for $1 million investment right now into your company? I know what you're saying. Oh, I'm going to make sure I give no more than 50%. I want to be about 51 to make sure I have control and power. That sounds good. It really, really does. But sometimes VCs and angels come asking for more money than that, and it's a big negotiation. And it's according to how bad you need the money, how much you're willing to give up. Now, I'm going to tell you about things that happened to people I know and how they lost their company completely. That's right, their dream, their hopes, their wishes, everything that they put into it, gone because they made a bad move accepting outside funds. So the first one has to do with dilution of ownership. Yes, you're going to lose percentage of your ownership by giving it up to people who are investing money. That's not what I'm talking about. I'm talking about a thing called vested, being vested in the company. This is something that they put in their terms in order to put you in a weaker position. What do I mean by that? Well, with a friend of mine who had his own company with some partners, they accepted over $8 million worth of VC money. Now, they were already operating, they were already producing revenue, but they needed this money to grow quicker, faster, better. And they accepted these funds with the terms that were presented before. And this was the biggest mistake they ever made. Upon signing the paperwork, they were told that they had to go back to 0% of ownership, and they have to be vested over the next 2 years in order to gain that percentage of ownership back. What do I mean by that? Okay, so let's just take a generic example. Let's say you owned 100%. You say, I'm not going to do no lower than 51 because I want control and power. So what they're going to tell you in your terms in order to receive this $1 million is that you have to go to zero vested stage, and that for the next 2 years, you will receive 25.5% of ownership because they want to make sure that you are committed to the company and that they're not going to give you the money and then you run off to the Bahamas and keep 51% of the company. Yes, I understand their position in wanting to protect themselves. But at the same time, if you only vested for 1 year and you're no longer with the company after that first year, you only have 25.5% ownership. I know what you're saying. Wait a minute. So I'm going to stay for 2 years. Why would I leave early? Well, you got to remember something. You are a two-pronged person when it comes to your company. You are an owner and you're an employee. Therefore, as an employee, you have to stay to be vested, just like it is with your 401k at work, okay? So if after the first year, the board that is commenced, that governs the company, decides you're not doing an efficient job and that you should be replaced or removed or fired, use that term, then you will be, poof, gone from the company. And therefore, you would not have the additional year of being vested. So you would be stuck at 25.5% ownership. Who gets the rest? The VCs get the rest. Exactly. Now they have majority share of your company. They bring in a new person, just like they did to the person that I know. They bring in a new person to run it, and you were out, just like the person I know was out. Right? You see how that trick works? Now, you no longer have your dream. You no longer have your company. You no longer have your sweat, blood, and tears. You have been marginalized out. Now, you're saying to yourself, hey, at least I got the 25.5%. So, I mean, they can't do nothing about that. Well, let me put a caveat to that, okay? So, I'm going to finish this for you. They turned around in order to get the other 25.5% ownership away from this individual, okay? They turned around and accepted a loan from another entity that they were in partnership with. And that loan agreement, because remember, they're a majority now that you're gone, that loan agreement stated that if they did not pay back the full amount within a 6-month period of time, that that entity would take full ownership of the company. So you tell me what you think happened. You got it. They defaulted on the loan. That other entity took 100% ownership of the company. Now, let me ask you this question. Do you think the VC was a partner and owner of that other entity? Certainly was. So now the VC has 100% ownership of the company, and you no longer have that 25.5% ownership. Now, I'm not saying that all VCs do this. I'm not saying that everybody plays what I call dirty, because this is something that you dreamt, that you came up with, that you worked hard on, and that you deserve to be rewarded for. But there are a lot of bad actors out there. And this is why I say there's a dark side to receiving outside funds. Now, bootstrapping, it's going to be something that you can do, but it's not going to give you the glory, the glam, or the speed, or the strength that VC funding would give you. You're going to move slower. You're going to struggle. You're going to have to be more efficient. You're going to have to find more innovative ways of doing things in order to bring your product or service to market. But I think it's a good thing because it makes you more efficient. It makes you sharper. It breeds innovation, and you're going to be better for it. And on top of that, now this is the caveat that a lot of people don't get when it comes to bootstrapping. If you bootstrap, you get your product or service out there, you start making revenue, it puts you in a power position to negotiate if you need to receive outside funds. Because you are independent, self-sufficient, you do not need their funds to be in operation. You need it merely to grow faster, bigger, stronger. Therefore, you can negotiate better terms, saying, no, I'm not going back to zero vested. No, I'm not accepting the dilution plan that you have in place, that I am going to do it this way. And they either come to your terms, or you keep it moving, or you go to another VC or some other independent investor, because you're not in desperate need for their funds. That's where bootstrapping comes in as a power play. Now, you still can be tricked, even when you're bootstrapping and you're in a power position. Let me tell you scenario number 2 that another associate of mine got screwed out of their company with. All right, so they found a VC firm to give them funds to be able to grow. They negotiated with this VC firm, and this VC firm used everything in the negotiation against them. What do I mean by that? When a VC firm is considering to invest in you, there's multiple things that open you up to being vulnerable. Number 1, you got to share your intellectual property. What makes your product or service unique? You have to share that. I know you say, oh, well, we'll sign an NDA, non-disclosure agreement. Well, most VC firms, outside investors, will not sign a NDA because they'll say, well, we get a lot of different business plans on a lot of different companies that come across, and we can have one that's similar to yours, and we don't want to have to, pin ourselves down, and we don't want to put ourselves in a situation where we can get sued. So you kind of feel a little desperate because you want to get access to the money, and that's the phrase and what all VC firms tend to use. So you go ahead and says, okay, I'll share that information with them. You share that information. That is a little position of vulnerability. But I'm not saying this is something that you should 100% worry about. There's other telltale signs, okay? So my associate did the same thing, and they were negotiating to be able to be in a position where they're not zero vested, that they're keeping majority ownership, that they're having certain rights, and so forth. And it was working out great. They were in a power position, and they were vibing very well. But what they did not detect was the strategy that the VC firm was using. They strung out these negotiations for over 6 months, going back and forth, changing things in the agreement and coming to terms with it. Why is that a problem? Because the VC firm knew the sales revenue of this company, and they knew their burn rate, and they knew their cash on hand, because you have to divulge all this information in order to get VC money. So they were able to detect exactly when this company might be in dire need of capital. So they continued this negotiation long enough to get to the finish line of this company being in dire strait financially, needing the funds, where at one time they were in a power position and didn't need the funds. So the VC firm now has the leverage, because my associate and them were in position of needing the money beyond belief. And this is another trick that could be used to get your company. Because when you're in a desperate situation, worrying about closing your doors, worry about your dream fading and going away, and having the opportunity to be able to realize your dreams on a national stage, you are going to make some bad moves. And they did. They signed the terms that the VC wanted, and they went back to zero vested because they were desperate. And they used the same trick on them, bam, again. This is what I'm talking about when I'm saying the dark side. All VCs are not this way. Please do hear me when I say that. But it's important when you are, talking to VCs, that you are looking at these particular things, keeping your eye on your cash on hand, your burn rate, your revenue, making sure you're operating your business just as if they were not there in your negotiation. So that way you won't find yourself in that position. Again, this is how bootstrapping can be a benefit. If you're being efficient, if you're being innovative, then you're producing the numbers you need to be able to operate anyway, therefore keeping yourself in a powerful position. Bootstrap long as you possibly can, strengthen your position as powerful as you can, and then entertain VC funding. That's the trick. Now, in order to get VC funding, in order to attract it in the first place, you must have your company structured the right way. You must be operating the right way. You must be efficient. And to do so, you have to know what you're doing. So this video up here, I did this last week, and it's just for you, telling you how to structure your company, how to put yourself in a position to be able to set VC funding and allow you to have the leverage. So check this video out, and also check this one out as well. This is your boy J.I., a random podcast. I'll see you on the other side.